Looking for solid Canadian companies with serious growth potential to anchor your investments for the long haul? You're in the right place. Before we reveal our top 5 buy and hold picks for the next 15 years, make sure you're subscribed and have those notifications on. You won't want to miss these insights. Alright, first up, let's dive into a sector that's always evolving, always captivating: fashion. But we're not just talking about trends and runways today, we're looking at the business behind the style, the companies that are shaping the future of what we wear. We're kicking things off with Aritzia. Now, if you're into fashion or just appreciate a well-run business, you've probably heard of Aritzia. They've absolutely exploded in popularity over the past few years, and for good reason. This Canadian retailer has mastered the art of creating high-quality, on-trend clothing that people absolutely love. But here's the thing, Aritzia isn't just about looking good, they're also a growth machine. Over the last 5 years, Aritzia has grown its revenue at a compound annual growth rate of 21.7%. That's insane. To put that in perspective, that's like your investment portfolio more than doubling in size every 3 years. And get this, even during the pandemic, when most retailers were struggling, Aritzia managed to stay profitable. That's a testament to the strength of their brand and their loyal customer base. They've cultivated a community around their clothing, and that's incredibly valuable in today's market. But what really excites me about Aritzia is their massive growth runway in the US. They're just scratching the surface of their potential down south, and I think we're going to see a ton of new store openings and a surge in online sales in the coming years. Their e-commerce platform is already strong, and as they continue to invest in it, I expect that growth to accelerate. Now, I know what you're thinking, isn't Aritzia's valuation a little high? And yeah, it's true, they're not exactly cheap. But remember, we're talking about a long-term investment here, and I firmly believe that Aritzia's growth story is far from over. They've got a winning formula, a strong management team, and a massive market opportunity. If they can continue to execute on their growth plans, I think Aritzia could be a multi-bagger from here. It's a company that understands its customer, delivers quality, and has a clear vision for the future. That's a combination that's hard to beat. Next up, let's talk about a company. We're diving into the world of finance, but with a twist. That's been absolutely crushing it in the world of finance, a true standout performer that's consistently exceeding expectations. goeasy. Now I know what you're thinking, finance? It can seem complex and intimidating from the outside. Doesn't sound that exciting, right? Numbers, charts, and jargon can often feel overwhelming. But trust me on this one. This isn't your typical run-of-the-mill financial story. goeasy is a leading provider of non-prime lending and leasing services in Canada. They operate in a unique niche within the financial landscape. Basically, they provide loans and other financial products to people who might not qualify for traditional bank loans. They fill a crucial gap in the market. Now, this might not sound like the sexiest industry, but it's actually a massive market, and goeasy is dominating it. They've carved out a significant share and continue to expand their reach. Over the past 5 years, goeasy has delivered an incredible 20.1% compound annual growth rate in revenue, and a jaw-dropping 26.4% compound annual growth rate in normalized earnings per share. That's right, their earnings are growing even faster than their already impressive revenue growth. This speaks volumes about their operational efficiency. This tells me that goeasy is becoming more efficient and profitable over time, which is exactly what you want to see in a long-term investment. It's a sign of a well-managed and sustainable business. And it's not just about the numbers. goeasy is also making a real difference in people's lives by providing them with access to credit that they wouldn't otherwise have. They're promoting financial inclusion. They're helping people build their credit, buy cars, and furnish their homes, all while generating impressive returns for their shareholders. It's a win-win situation for everyone involved. Now, the non-prime lending space can be a bit volatile, especially during economic downturns. But goeasy has a proven track record of navigating these cycles, and I believe they're well-positioned to continue their growth trajectory for years to come. They've demonstrated resilience and adaptability, making them a compelling investment opportunity. Let's face it, nobody likes to think about recessions. The very word can send shivers down the spines of investors and consumers alike, but they're a fact of life. Economic cycles are as natural as the changing seasons, and when the economy takes a downturn, when those inevitable headwinds start to blow, it's important to have some defensive stocks in your portfolio. These are the companies that tend to hold their value, or even thrive, when others are struggling. That's where Dollarama comes in. This Canadian discount retailer is a true powerhouse, a testament to the enduring appeal of value, offering a wide variety of everyday essentials at unbeatable prices. From household goods to party supplies, they've got it all. Think about it. When times are tough, people still need to buy things like cleaning supplies, kitchenware, and snacks. But they're going to be a lot more price conscious, carefully scrutinizing every purchase to make their dollars stretch further. And that's where Dollarama shines. It becomes the go-to destination for savvy shoppers looking to maximize their buying power. Now, you might think that a discount retailer wouldn't be a high-growth business. That deep discounts mean slim profits, but you'd be wrong. Over the past 5 years, Dollarama has delivered a solid 10.6% KGR in revenue and a remarkable 16.3% KGR in EPS. That's right, their earnings are growing even faster than their already impressive revenue growth, a sign of strong operational efficiency, proving that Dollarama is a well-oiled machine that knows how to generate profits. But here's the best part. Dollarama is incredibly recession-resistant. Its business model is perfectly suited to withstand economic storms. In fact, during the 2008 to 2009 financial crisis, while most retailers were struggling, many even facing bankruptcy, Dollarama actually thrived. Their sales and profits surged as people flocked to their stores to save money. It became a safe haven for budget-conscious consumers. This tells me that Dollarama is a true all-weather stock that can perform well in both good times and bad. It's a company that seems to defy the typical economic cycles. So, if you're looking for a reliable defensive stock with a long track record of growth, a history of weathering economic storms, Dollarama is definitely worth considering. It might just be the recession-proof retail champion your portfolio needs. Alright, let's talk about the elephant in the room, or should I say the giant online shopping cart in the room, Shopify. This Canadian tech darling has become synonymous with e-commerce, powering millions of online businesses around the world. From small startups to massive brands, Shopify provides the tools and infrastructure businesses need to thrive in the digital age. Now, Shopify's growth story is nothing short of remarkable. They've gone from a small startup to a global e-commerce powerhouse in just a few short years. And while their growth has slowed a bit from its pandemic-fueled highs, I believe Shopify still has a tremendous amount of growth potential ahead. Why? Because e-commerce is still in its early innings. More and more people are shopping online every day, and Shopify is perfectly positioned to capitalize on this trend. They're constantly innovating, developing new features and services to help their merchants succeed. From payments and shipping to marketing and analytics, Shopify offers a one-stop shop for everything e-commerce. Now, I know Shopify's valuation can seem intimidating, but remember, we're talking about a company that's changing the way we shop. They're the picks and shovels of the e-commerce gold rush, and I believe they're going to be a dominant force in this industry for decades to come. Finally, let's talk about a company that's literally delivering the future of e-commerce, Cargojet. This Canadian cargo airline is the backbone of online shopping in Canada, providing overnight air cargo services that connect businesses and consumers across the country. Think about it. When you order something online and you want it fast, chances are Cargojet is the one getting it to your doorstep. Now, Cargojet might not be a household name like Shopify, but they're just as crucial to the e-commerce ecosystem. They provide the essential logistics infrastructure that makes online shopping possible, especially in a geographically vast country like Canada. And as e-commerce continues to grow, so too will the demand for Cargojet services. They've consistently grown their revenue and earnings at an impressive clip, and I believe this trend is set to continue. Now, Cargojet does face some risks, such as rising fuel costs and competition from other logistics providers. However, I believe their strong market position, long-term contracts, and focus on innovation will allow them to navigate these challenges and continue to thrive. So, if you're looking for a unique way to invest in the e-commerce boom, Cargojet is definitely worth a closer look. There you have it, 5 Canadian growth stocks that I believe have the potential to deliver market-beating returns over the next 15 years. Investing for the long term requires patience and research, and we hope this video has given you a great starting point. Remember, this is not financial advice, and it's important to do your own due diligence before making any investment decisions. What are some other Canadian growth stocks on your watch list? Share your thoughts in the comments. If you enjoyed this video and want more like it, hit that like button and subscribe for future updates.